Now we're going to be talking about CFA Investment Management Certificate, Chapter 12, Section 5. The chapter say about the extent of institutional involvement in modern financial markets. In the UK, the large proportion of gilts and UK equities are held by investment institutions. This institution enable small investors to purchase a stake in large, well-diversified portfolio of assets that they would not be able to perform it. So it's now the most popular way of private individual to invest. The most important investment institution in the UK are pension funds, insurance companies, investment trusts, and unity trusts. Pension funds, there are two types: defined benefit and defined contribution. In the former, the sponsor agrees to pay members of the scheme a pension equal to a predetermined percentage of his final salary, subject to the contributor's years of service. And the contributions are used by investment, and the return of it determines the pension benefit. So the whole funds that deposited in the scheme will be used to invest in equities or many different types of assets, and the return will be delivered to the benefits of pensioners, in this case of the employee, sponsored by the employer. Occupational scheme, where the sponsor is the employer, may be either defined benefit or contribution. In both, there is an inflow of cash which are accumulated and invested, and the other source of pensions. Provisions is from the state which provide a basic flat rate pension and an additional tiers. The state second pension (S2P), which is earning related. The investment in pension funds benefits from certain tax exemption, so the interest and the capital gain are not liable to taxation. They are liable to taxation whenever the pensioner receives a payment, so the pension manager usually are required to invest in long term. Actuaries, those professionals who calculate statistic and make provision, who take into account, for example, death rates in order to determine the average length of time that an employee will draw a pension, and so estimate the future liability stream. So actuaries do this job, that's his work out how long it take to the person get the funds back, and event they make the project, they plan the liability stream, so they sponsor pay based on their actuaries plans. The trustee, who is appointed to ensure that the pension is managed competently, intently will often determine the proportion of assets to be held in different asset classes: equity, fixed income, security, property. So the trustee has the roles of keeping in touch with the fund manager to guide him about what the scheme has to achieve. As the maturity increases, the trust may wish to invest more in funds assets, in fixed income securities, and less in equity, thereby reducing the uncertainty about funds' future cash flows. The management must be keen to set investment objectives which maximize the return on fund management. In the short term, in order to reduce the sponsor's contribution rate, trustees always prefer less risky investment policy to have sufficient funds to meet the liabilities. Professional funds managers often are in commercial banks, subsidiary life insurers, manage pension funds. The investment policy of both individuals and the institutions have the same treatment towards taxation, as they do not have to pay even capital gains. But pension fund manager still prefer to receive dividend income rather than capital gains, because the capital gains when they receive is taxable, and that's why they just postpone in the long term, as the dividend is not taxable. And to adjust a portfolio by realizing the capital gains incur transaction costs. That's why they prefer dividend. Firstly, on the sale of a security to realize the capital gain, and secondly, through the purchase of new security. The selection of a specific asset for pension funds is usually determined by the pension fund manager according to the general guideline laid down by the trustees. Since 1997, it's not taxable, right? So the trustee, since the funds flow income from contributors, the fund manager may wish accumulate so as to buy more securities when they decline in prices. Defined benefits brought a lot of problem over the past 10 years due to the deficit that the system faced. Therefore, the defined contribution passed to increase, and there is a huge number of them. Was increasing in the longevity, which increases costs for the scheme, as it made defined benefits switch away from equities towards bonds and LDI. LDI stands for liability-driven investment strategy that involve not just switch bonds but use of swaps and other derivatives to more accurately. The insurance companies, they provide personal pension, undertake a significant and growing proportion of funds provisions. However, owing to the different tax treatment of pension funds with respect to the other funds under the management of an insurance company, business which consists of two parts. Insurance, insurance company do life insurance and general insurance businesses. Life insurance generally involve long-term liabilities that are based on the contract sold by the company to the individual who sign sign up a contract normally for 10 years, but if he survives, no payment will be made. Some are between 20 and 40 years. So this is long term. In the 80s and 90s, this type of contract has been increased quite a lot because we've based to so many problems in the economy and the pension scheme. People tend to go for life insurance. Well, this is the endowment policy combines a saving element that ensures the person may choose a way to cover his mortgage after getting retired in case of his death, or withdraw the same amount of his outstanding balance whenever the contract ends. The financial service authorities find so many companies that do not make their clients fully aware about the risk because those funds are invested in other securities. So they set up a contract of life insurance. As the institution receives the funds from the insured person, all those funds are invested in other securities. So the institution has the duty of keep all insured person fully aware about it. If a downturn in the global economy or the global market much bring a deficit to many investors, as came about in 2000, between 2000 and 2002, which left most of mortgage holder unable to repay their mortgage. So since the liability businesses of life insurance is long term as their portfolio of asset. So the portfolio is long term as well in order to match with the liability. The life funds businesses are liable to tax on the capital gain and income as the fund. As the fund manager will adjust his investment strategy to minimize the tax which pays on his funds. The general insurance companies, the institution usually perform their investment in short-term securities with high liquidity because in event of pay claims, they need the funds immediately. The asset allocation, funds objectives and constraints. The decision was to what proportion of a portfolio to allocate to various asset classes is determined by the reviewing the objective and constraints of funds. For example, defined contribution or defined benefit pension. For the defined benefit pension fund will be aiming to cover projected liability, some of which are immediate and short term, and some of which are long term. For employee, many years from retirement. For ages, these are long term. If the staff are really young, they all are long term. The two keys classes of objectives are to maximize return, to match projected liabilities. In achieve those objectives, there is a trade-off, as the more risk-averse funds, the lower the degree of risk and the lower the return. Liquidity needs: if the portfolio requires funds to cover unanticipated changes, the short-term government is the bond is the best choice. If the company want to set up a portfolio with very short terms and do need a liquidity, the best choice is to buy a gilt, which is T-bonds, are financial instrument issued by the government, because it is acceptable in a snapshot in a financial market. The time horizon: the longer the time horizon, the higher the risk of asset. A young pension fund with low proportion of retired to active members can afford to allocate more of its portfolio to long-term, high-risk assets such as equity and property. A more mature pension fund with shorter average duration of liability would allocate a large proportion of its fund to fixed income with duration to match its liability. Tax. About the tax status of funds will affect the return objective and make some asset classes less desirable than others. For example, charitable funds and pension funds, which pay no tax on income or capital gains, should consider carefully investment where tax is deducted at source. Growth funds will also avoid tax-free investments, since these come at a premium that provides no added advantage to a tax-free fund. Legal and regulatory: these constraints may exist and need to be borne in mind when constructing the funds. Example: authorized unit trusts in the UK have a restriction as to which asset classes they can invest in, such life science companies. Ethical constraints as these have become more widespread in the last 10 years. The asset class distribution: at the end of 2008, UK pension funds had a total of 864 billion. There was just about 160 billion down on prior years due to fall in global equity markets in 2008. This is many times greater than Germany and France pension funds. This due to the difference of social security provision in each country. Since equity offers a suitable match for long horizon pension funds liability, which are closely related to the wages of the assets held by the average pension funds, 40% in equities. So of the assets they collect, all these funds, 40% are invested in equities. So if the wages, earning in dividends all grow together, then the value of the asset would move in the same line. So they keep up with all other prices. Fixed income securities play a small role in the overall picture, with about 18% of the pension asset in fixed income security. It's been 11.5% in the UK. Other countries within Europe, this percentage is much higher. Denmark has 70%, Germany 75%, Portugal 76%. Short-term asset holding were also high in 2008 due to the crisis. Life insurance, the second largest group institutional of investors, is the long-term insurance funds. Life funds also have very long-term liability. Nearly 50% are invested in equity and landed property due to this type of asset tend to rise with the general level of prices. In general insurance, the net asset of general insurance companies are relatively small to pension and life fund net asset because it refers to pooling of householder, motoring, personal accident, and other short-term risk, where policies are usually renewed on an annual basis. Some are semi-annual. No, the time horizon. Pension funds can have very long liability, which may vary between 20 and 40 years. As these funds flow into the institution, that allows the institution invest in many other securities with short term, as it grants ability to focus on short period as yield flexibility and volatility. Some family-run company with little job turnover and no retirement intention will require low liquidity for each scheme. The taxation for it, pension funds are exempted from taxation on income and capital gain since 1997. But the investor from overseas withdraw his fund, he may not be recoverable due to exception in this case. Like, let's assume some countries have a taxation agreement. Let's assume if UK would be 30% tax and Greece 30. So if the person paid the tax here, can compensate 50% in his country. But if the country has not an agreement with the UK, if the person is completely exempted here, but he will be fully taxed in his country, so there is no way out for him in this, for instance. And general insurance and life insurance companies operate within detailed legal framework intended to prevent such a company from being unable to meet future liability and avoid fraud. And in the US and the UK, there are some difference on this matter. But if you look through the investment, it's really recommendable when the investor go into it, ask for the investment manager to keep him informed all along.